Welcome to the Founders Journey podcast. Inspiration, education for founders by founders.
Hey, I'm Greg Moran from Evergreen Mountain Equity Partners and Evergreen Growth. In today's video, we're going to actually dive deep into the world of venture capital and focus on a crucial topic that can be a bit arcane, but super important for a founder to really understand. That's the investor rights, topic of investor rights, particularly for a VC or really any investor. You hear this term, but not enough founders understand it or pay any attention to it. And they can find themselves really in the losing end of a deal without really understanding the rights that they're giving up. So they really focus on a headline valuation topic, which we've hit on in other videos. But this concept of investor rights is enormously important. If you're a founder seeking funding, or if you're an investor looking to protect your investment, it's equally important. So you really want to understand these rights. It's just an essential part of being an investor or taking investment. So let's really start to dive into what investor rights are and how they work. So VC investor rights are really legal provisions, right? And they're designed to protect investors and startups. The rights ensure that investors have some control over the key decisions so that they can really safeguard their financial returns. Not every decision. Investors don't want to be making day-to-day operating decisions, but there are really key decisions that they need to have a say in. And they really have big impact. They can range from things like voting rights to sometimes what you hear as liquidation preferences, which are really important. And that each really play a pivotal role in the venture capital ecosystem. So again, really important that you understand it. So let me kind of dive into a few of these rights that you hear about a lot. First, I mentioned before, liquidation preferences. This is one of the most important rights that investors will negotiate for. If you're an investor and you're investing in early stage companies, this is something you really need to be looking for to really safeguard your return also. Really what this does is it determines the order in which investors get paid if the company gets sold or if it gets liquidated. So typically preferred shareholders, often the VCs or early stage investors, get paid before common shareholders. And often that's management or employees, things like that, are in that common pool. What the liquidation preference does, it ensures that investors can recoup their capital before returns are started to share with other shareholders. It's a really important thing to understand. You'll see liquidation preferences oftentimes in the form of like 1x, 2x, things like that. And really what that means is if somebody has a 1x liquidation preference, they get 1 times their money back. So if I invest 10 million, I get 10 million back before anybody else gets anything. Important thing to recover the money for an investor first. Anti-dilution rights are another really important topic. And what they do is they protect investors from losing value in their shares if future shares are issued at a lower price. This often happens at startups where you have what's called down rounds. What happens is you raise money today at 10 million valuation, and things don't go necessarily as planned or the market shifts or something like that, and you have to raise at 8 down the line. That's a down round. Anti-dilution rights protect investors from losing value in their shares, because if you're having other investors come in at a lower value, that dilutes everybody. So there are a lot of different forms of anti-dilution protection. The two that you'll hear about a lot are what's called full ratchet and what's called weighted average. And they both have really different impacts for investors. Full ratchet, basically everybody, there's a full dilution. Weighted average is you're basically weighting the previous value. Again, these are terms that you understand them. Take some time, Google them, but most importantly, talk to your advisors. Get good legal counsel, get good accounting counsel. You've heard me talk about this thing before. Don't be cheap. Understand the impact of these provisions when you see them in a term sheet. If you're not familiar with what you'll see in a term sheet, we have a video on that as well. So the other area that you'll see in investor rights is voting rights. And what they do is they give a say to investors in really important company decisions. Things like merging the company, issuing new shares, which means raising more money or debt or something like that, selling the company. These rights really ensure that investors can influence the decisions that are going to impact their investment. Important that investors, if they're investing a large amount of money, have a say in this. The other type of right you'll see is what are board seats and what are called information rights. Probably all familiar with having a board, but I think a lot of founders don't really understand the importance of a board. Many investors will want to secure, myself, for instance, I do this all the time, will want to secure board seats with their investment, because what that allows me to do as an investor, or any investor, is to actively participate in the company's governance. Again, I want to be able to have a say in those big, important decisions that are going to impact my investment. Additionally, there's something called information rights. Usually just it's kind of a step below a board seat. You'll often hear like board observer, things like that. What they do is they give investors access to financial statements and other key documents that are distributed to board members to really help keep them informed about the company's performance. It's really important as an investor so that it doesn't turn into a passive investment, but you can really understand what's happening with your investment and understand its performance. So how do these rights impact both founders and investors? Well, for founders, these rights can really sometimes limit the control over the company, but they're often necessary to secure the investment that you need to grow. You're probably not going to raise institutional or VC capital without giving up some of these rights. You're almost certainly going to have to. So they're a necessary part, and they're necessary for investors too. These rights are really about mitigating risk and ensuring a return on your investment. As an investor, as a venture investor, I'm a fiduciary for my investor. I have investors as well. They're called limited partners, LPs. I'm a fiduciary for their money. I need to make sure I'm mitigating their risk and I'm setting them up for the best possible return on the investment. So it's really a delicate balance that needs to be carefully negotiated when you're going through the term sheet. Again, have good counsel that is used to doing early stage equity kind of deals to help you through this process. Don't try to figure this out on your own. So while negotiating these rights, both parties really have to be aware of some of the common pitfalls that can really crop up when you're going through and putting these rights together. One, founders have to be cautious of overly aggressive terms. Sometimes investors are of varying quality. Sometimes they become very overly aggressive. They put in onerous terms that really end up hindering future growth or making future funding nearly impossible. Sometimes these rights have to be undone. I've actually had to do this myself, where I've seen rights that were given up by a founder to investors in a previous stage where I come in and make an investment. I've had to go, as a term of my investment, I've had to go have the founder have to undo the rights that they gave up. It's not a good position. Doesn't win you a bunch of friends as a new investor either. So you want to be careful of really overly aggressive terms that really hinder future funding. Investors, on the other hand, have to really ensure that their rights are well drafted so that they can protect their interests without doing what I just said. That's stifling the company's long-term potential. Nobody wants to do that. It's not the investor's best interest. When those things happen, it's usually because of poor negotiation, poor legal drafting, things like that. So communication and transparency are really key in achieving a long-term win-win scenario for both the founder and the investor. So that really wraps up our deep dive into investor rights. Understanding these rights is really crucial, whether you're looking to secure investment as a founder or you want to be an investor in startups and safeguard your stake within those investments. So if you found this video helpful, make sure you like it, subscribe it, hit the notification bell for more insights on venture capital, and be sure to visit us at emep.io. Check out our blog. We've got a lot more content like this. That's our Evergreen Mountain Equity Partner site. That's our venture fund. And our growth practice, which really focuses on long-term scalable growth at evergreengrowth.io. So emep.io and evergreengrowth.io. We'll see you in the next video.